benefit plans are a bit of a dinosaur in private industry, but they're still around in the public sector. Defined contribution plan means that the employer commits to making a certain contribution, whereas a defined benefit plan means the employer commits to paying a certain benefit, perhaps for the life of the retired employee. So let's take a ridiculously simple problem and see if we can extrapolate from there to imagine how we could get a huge unfunded pension liability. So we run the yarn barn and we want to convince our employee of the month to stick around until he's age 65. So he's age 60 now. We want him to stick around for 5 more years. So we agree to pay him half of his then salary when he retires for the rest of his life. Okay, so first of many assumptions, let's assume that we think he's going to earn $37,834 at age 65. So half of that would be $18,917. Let's assume that we think he's going to live 20 years. So let's find the present value of that $18,917 a year for 20 years as of the date that he retires here, which is age 65. So first let's find the present value of $18,917 a year for 20 years. Did I say 20 years? So 20 is the end. Let's assume 10 is the right discount rate. We think that the stock market, where we're going to invest these funds, in the meantime, is going to earn us about 10%. We said it was 20 was the end, that 10 is the I, and that 18,917 is the payment. We find the present value of that, and it's 161,050.09. So now we know the present value of that annuity there. We have to find the present value today. So let's set that up to be our future value. Let's say he's 60. This is supposed to kick in when he's 65, so that's 5 years from now. We decided that 10 was the interest rate. Let's clear out the payment, and that's compute PV, and it's $100,000. So if we set $100,000 aside in some plan assets, and they earn 10% per year, when we get to his retirement date, we'll have $161,151.09, which then can pay him that $18,917 for 20 years. So what we can do is we can write a check for $100,000, credit cash for $100,000, debit pension expense for $100,000, and that money goes to a trustee who will invest those funds conservatively, so that hopefully we'll have $161,051.09 when our employee of the month retires. Suppose we don't have $100,000. Suppose we fund it with only $90,000. Now we're underfunded and have a pension liability on our books for that $10,000. All right, let's pretend like we've fully funded the first year with $100,000. We give it to the trustee. They're investing the funds. Let's pretend like the funds don't earn anything. And we get to the second year. Well, if nothing else has changed, at a minimum, this long annuity here for 20 years is now 1 year closer. So we're now here on the timeline. So when we found the present value, we took the interest out. Let's put the interest back in. 10% of that $100,000 liability is $10,000. Another way to look at it is the N is no longer 5. It is now 4. 4N. And then we'll hit compute PV. And sure enough, it's $110,000 now. So we have to book $10,000 worth of pension expense. If the pension assets don't earn anything, we'll debit pension expense for $10,000 and credit cash for $10,000. What if we only write a check for $9,000? Well, if we only write a check for $9,000, then our pension liability would increase by $1,000 because it's underfunded. And of course, what hopefully will happen is that the pension assets will earn $10,000, and we won't have to write a check for $10,000. And in fact, there'll be no journal entry on our books because the plan assets did exactly what they're supposed to do. And so if we're Yarn Barn, this is pretty easily managed, the assumptions and all that. But imagine you're a huge multinational corporation, or you're a government agency with thousands and thousands of employees of various ages, who have various vesting periods, who have various assumptions about future salaries. And you have to hire an actuary to estimate what this future stream is and all the assumptions that go into the interest rate that we're going to use to discount it. So defined benefit pension accounting seems complicated, but it's all based on this simple example that we have to have enough money set aside in these plan assets to cover our future liability. Hope that helps.